Today we are going to see 12 option strategies that all options traders should know. 1. Long put option strategy. The long put options trading strategy offers an individual the right to sell an underlying stock at the specified price. When the investor purchases a put option, he or she is betting that the stock will fall below the strike price before the expiration date. Using a put instead of shorting the stock reduces the risk to the investor, as they can only lose the cost of the put, versus unlimited risk associated with shorting the stock. If the stock rises, the long put option will expire worthless, and the investor will lose only the cost of the option. Likewise, an investor who shorted the stock will continue to lose more and more as the stock continues to climb higher. When purchasing puts, especially short-term, there is a need for investors to be careful. If an investor buys many put contracts, their risk also increases. This is because the options can expire worthless, whereby the investor would lose the entire investment. When to buy put options. There are many reasons to buy put option contracts. These can be for speculative purposes, meaning the investor believes a stock price is going to fall. A long put can also be used as a hedge against stock already owned, to protect an asset if it's to have a sudden turnaround in value, also known as a protective put. Here, if the stock that is already owned suddenly dropped, owning a put option would increase in value, offsetting the losses incurred from the stock. Buying a put versus shorting the stock. For investors who want to take a bearish position in the stock, shorting the stock and buying put option contracts are the most popular strategies. Shorting a stock is a risky endeavor, as a stock's price can increase to infinity, which is why shorting a stock has unlimited risk. Buying a put is an alternative bearish strategy, as an investor can only lose the cost of the put, so its risk is limited. Both of these strategies have limited profit potential and gain value as the stock falls, but a stock can only fall until it reaches zero. But buying a put option is a way to capitalize on the downward movement in a stock while ensuring risk is limited to the premium paid for that option contract. Profit, loss. Maximum loss equals net premium paid. The maximum gain for a long put strategy is unlimited, as the stock can continue to move down, gaining more and more value, at least until it reaches zero. Break-even. The break-even on a long put option is calculated by subtracting the premium from the strike price. If a stock is trading $100 and an investor wants to buy a 90 strike price put for $2, then the break-even would be $88. Example: if stock XYZ is trading $100 and the investor thinks the stock is headed down, he may buy a 90 strike price put option for a $2. If the stock trades down to $85, they will make $5 on the 90 put. But because they paid $2 for the option, their net gain will be $3. If, however, the stock continues to trade up or never trades down to $90, they will lose their $2 investment. Conclusion: the long put is an investment practice that allows the investor to wager on the decline of the stock. The investor must be able to handle the potential loss of the entire premium if they are wrong. Whenever there is a decline in the underlying price, the traders can earn much more through puts ownership compared to short selling. In short selling, the risks are uncapped because there is a possibility of the stock price continuing to rise without any limits. 2. Short call option strategy. The short call option strategy, also known as uncovered or naked call, consists of selling a call without taking a position in the underlying stock. For those who are new to options, they should avoid the short call option, as it is a high-risk strategy with limited profits. More advanced traders use a short call to profit from unique situations where they receive a premium for taking on risk. Let's take a more in-depth look at the short call option strategy. Investors open the short call strategy when the prediction for the underlying asset is bearish to neutral. Upon making the sale, the trader has an obligation to sell the stock at the strike price if the buyer of the short call exercises the option. This should not be confused with the short put option, where the seller has an obligation to buy the stock at the strike price. In the chart above, once the stock moves past strike price A, the trader starts to lose their profit. Once it moves past the strike price by more than the premium received, they start taking a loss. With this strategy, it's in the investor's interest if the call option has no value at expiration, thus expiring worthless. When executing this option strategy, it's a good practice to wait until the strike price is one standard deviation out of the money. However, the strike price will negatively affect the premium received. The more risk, the higher the reward. With a short call, the trader wants the implied volatility to decrease, as this will reduce the price of the options they're short. Here, if the investor decides to close the position before the expiration date, the trade will cost them less to buy back. Similarly, decreasing time to expiration is also a positive factor with this strategy, because the less time to expiration, the lower the value of the call option, enabling the investor to close the position for less. When to execute a short call. The short call is one of the two options strategies a trader can implement to make a bearish bet on the market. The other being buying put option contracts. The seller of a call option is betting that the stock will not go over a specified price before the option expires in exchange for collecting a premium. This type of bear market trade is often placed when a stock has already had a big run to the upside, especially over a short period, and technical indicators, such as RSI or %R, show that it's overbought. By selling a short call, the trader is obligated to the options buyer, thus guaranteeing that they will deliver the stock to the buyer of the call option if the stock goes over the strike price. If the price of the stock stays under the strike price, the short call option holder keeps the entire premium as profit. However, if the stock price rises above the strike price, the long call holder will exercise the option and force the short call holder to go out into the open market and buy the stock at the current market price, delivering it to them at the lower price. It is not uncommon for investors who already own stock to sell upside call options for additional income, known as a covered call. This way, if the stock does rise, the investor hands over the stock that's already in their inventory. Profit, loss. Maximum profit equals net premium received. The maximum loss for a short call strategy is unlimited, as the stock can continue to move higher with no limit. Break-even. The break-even on a short call option is calculated by adding the premium to the strike price. If a stock is trading $100 and an investor wants to sell a 110 strike price call for $2, then the break-even would be $112. Example: if stock XYZ is trading $100 and the investor wants to sell a 110 strike price call option, they can collect a $2 premium to do so. If the stock trades up to $115, they will be forced to buy the stock at $115 and then deliver the stock to the call buyer at the price of $110, losing $5 in the process. But because the option seller received $2 when they sold the call, their net loss is $3. If, however, the stock continues to trade down or never reaches $110, the trader keeps the $2 premium as profit. Conclusion: the short call option is an excellent strategy for experienced investors who want to capitalize on selling volatility when markets are overbought. As time moves on, the premium received decays, allowing investors to either keep the whole premium or repurchase it later for a lower price. Beginning traders should not use this strategy. It is far too dangerous, as the maximum loss is unlimited. Besides individual stocks, sometimes investors also like to sell call index options. A reason for trading index options is because they are considered to be less volatile compared to individual stocks. The potential for profit with this strategy is low due to the unlimited risk involved if the stock continues to rise. Traders prefer to sell calls because the possibility of profiting from it is high if the option is very out of the money and the trade is timed correctly. 3. Short put option strategy. With the short put option strategy, the investor is betting on the fact that the stock will rise or stay flat until the option expires. If the put option expires worthless, out of the money, then the trader keeps the entire premium, which represents their maximum profit on the trade. When it comes to single option trades, selling a put option is one of two bull market strategies, the other being the long call option. As we discussed, the seller of the short put is obligated to purchase the stock, in most cases 100 shares per contract, at the strike price if the buyer wants to exercise the contract. Selling a put option can be valuable to investors as it allows them to increase their income, taking premium from other traders who are betting the stocks would fall. Therefore, when using the short put strategy, the investor receives the premium, cushioning themselves from a flat market with little movement. Nevertheless, investors need to sell their puts sparingly because they are on the hook to purchase shares if the stock falls below the strike price by expiration. An investor should keep a close eye on volatility levels when selling put options. The higher the volatility, the more risk to the trader, but the higher premium they receive for taking on this type of options trade. Short puts are used to achieve better buying prices on the overpriced stocks. Here an investor would sell the puts at much lower strike prices, at the level where the investor would prefer to buy the stock. When to use the short put strategy. If an investor believes a stock is going to stay above a specific price point or they wish to purchase the stock at a lower price point, selling a put option should be a consideration. Here the investor will sell put options with a specific expiration date in mind in exchange for receiving a premium. If the stock stays above the strike price, the investor will keep the entire premium as profit. If the stock falls below the strike price, the investor will be forced to buy the stock at that level. This is not always a bad thing. For example, if an investor wishes to buy a stock at $50, but it is currently trading $55, they could sell a 50 strike price put option contract and receive a $3 premium. If the stock continues to trade higher or fails to reach the $50 strike price, that premium is pure profit for the investor. However, if the stock falls below $50, the investor will be forced to buy the stock at that level. This, of course, is still $5 better than where they initially wanted to buy the stock, because they also received a $3 premium when they sold the put option contract. They now have a cost basis in the stock of $47. Selling a put option in this case is really a win-win scenario. Either they make a $3 to watch the stock trade higher, or they get to buy the stock significantly lower than where they initially wanted to purchase it. Profit, loss. Maximum gain equals net premium received. The maximum loss for a short put strategy is unlimited, as the stock can continue to move against the trader, at least until it reaches zero. Break-even. The break-even on a short put option is calculated by subtracting the premium from the strike price. If a stock is trading $100 and an investor wants to sell a 90 strike price put for $2, then the break-even would be $88. Example, if stock XYZ is trading $100 and the investor wants to buy it for the stock $90, they can sell a 90 strike price put option and collect a $2 premium to do so. If the stock trades down to $90, they will be forced to buy the stock, which is what they wanted, and at the lower price. Plus, they got paid $2 to do so. If, however, the stock continues to trade up or never trades down to $90, they won't get to buy the stock, but that $2 premium they received is theirs to keep. Conclusion. The short put is a good strategy. Traders are either paid to buy the stock at a lower price point than where it currently trades or paid to watch the stock trade higher. Either way, it's a win for the trader. 4. Covered call option strategy. The covered call strategy involves the trader writing a call option against stock they're purchasing or already hold, besides earning a premium for the sale. With covered calls, the holder also gets access to the benefits of owning the underlying asset all the way up to the strike price, where the stock would get called away. There are many different uses of the covered call strategy. Some use the strategy to make additional profits to the stock they hold while markets trade relatively flat. This is popular option strategy among traders because, besides the premium, investors can benefit from capital gains should the underlying asset increase in value. Out-of-the-money call trades are placed when the outlook is neutral to bullish. When to use the covered call. The covered call strategy is usually opened with 30 to 60 days before expiration. This allows a trader to benefit from time decay. Of course, the optimum time for implementing the strategy depends on the investor's goals. If the goal is to sell calls and make money on the stock, then it's best if there isn't a lot of difference between the stock price and the strike price. If the goal is to sell the stock and the call, then you should be in a position where the calls will be assigned. For this to happen, the stock price will need to stay above the strike price until expiration. Some investors sell calls and purchase stocks at the same time. This strategy is called a buy right, and it's used to decrease the cost basis of recently purchased stocks. With cover calls, there is no additional margin requirements on the stock as you own it. A suitable premium when selling the call is 2% of the current stock price. You should calculate how you can gain from the strategy and set a premium accordingly. Investors will receive a higher premium when shorting options if implied volatility is high. For this reason, many investors like holding the stock and then sell call options with a high premium to help cushion the risk of loss from a downward movement in the stock. Profit, loss. The maximum profit with this strategy is the difference between the strike price and the current stock, plus the premium received for selling the call options contract. Beware of the pitfalls of this strategy, though. The potential loss of this strategy can be substantial. This loss happens when the price of the underlying asset decreases. However, unlike stock trading, the downside is slightly less painful due to the premium received. That will cushion any downside stock movement. Break-even. The break-even point is the difference between the current stock price and the premium received for selling call options. Example. To understand OTM calls, let's consider the following example. A trader buys 100 shares of stock at $20 in May and writes a June 25th OTM call for $2. If at the expiration of the option, the price of the stock is $28, the strike price of $25 is lower than the stock price. As a result, the call is assigned, and the writer sells the shares at $25. Here the trader would have made $5 on the stock movement, plus $2 on the calls, for a total profits of $7. What if the stock price had gone down instead of up? In this case, the writer will have a loss on the stock, but a profit on the calls as they will expire worthless. If the stock traded down to $17, the trader would have lost $3 on the stock. But because they sold calls for $2, their net loss would only be $1. Conclusion: covered calls are a great way to generate additional income from owning stock and suitable for investors with all skill levels. 5. Bull call spread option strategy. A bull call spread is a vertical spread consisting of buying the lower strike price call and selling the higher strike price call, both expiring at the same time. The strike price of the short call, represented by point B, is higher than the strike of the long call, point A, which means this strategy will always require the investor to pay for the trade. The short call's primary purpose is to help pay for the long call's upfront cost. Profit, loss. The max profit of a bull call spread is calculated by taking the difference between the two strike prices minus the premium paid. This is reached when the strike trades over the above strike price at expiration. Max loss is the cost of the trade. This is reached when the stock trades under the lower strike price at expiration. Break-even. The break-even for a bull call spread is the lower strike price plus the cost of the trade. Break-even equals long call strike plus net debit paid. Example: a 55-65 call spread costing $2.50 would consist of buying a 55 strike price call and selling a 65 strike price call, have a $10 wide strike width, which is the most the investor could make on the trade, minus the premium paid to get into the trade, in our example $2.50, leaving the investor with a max profit of $7.50. Time decay is working against the investor if the call spread is out of the money because they need more time for this trade to become profitable. Time would be working for the investor if the vertical has both strikes in the money because they would want this trade to end. So there's no more time for it to possibly move against them. Conclusion: the recommendation. This is not a strategy that should be executed very often unless there is evidence of an expected upward movement. Without that, it's a lower probability of success trade that relies on a stock to trade higher. It requires less capital to participate than simply purchasing stock, which means lower risk, but is still considered to be a lower probability of success trade. 6. Bear call spread option strategy. The bear call spread is a vertical spread option strategy where the investor sells a lower strike price call option, represented by point A, and buys a higher strike price call option, point B, within the same expiration month. The investor will receive a premium or credit, as the lower strike price call will have more value than the higher call. An investor entering this trade has a potential profit that is limited to the premium they received when they executed the trade and a potential loss once the stock raises above their short strike price in an amount larger than the premium they received. The investor uses this strategy if they believe the market will stay flat or trade lower. The higher call is used as a hedge in case the market does trade higher, so the investor can cap their max loss. The bear call spread strategy. The bear call spread is an options strategy that works by letting the options decay slowly day after day until the expiration date, resulting in both options expiring worthless and the investor in keeping the entire premium. It is best to apply the strategy when it's expected that a stock will likely trade sideways or drop in price. This strategy tends to be a favorite among many traders and is suitable for all investors, as it allows them to apply a high probability trade with limited risk. It is best to apply once the stock has already had a sharp move higher and is overbought, or if the stock is expected to break down. It is best to apply the vertical call spread when implied volatility is high, which increases the option pricing, allowing the trader to receive a higher premium on the trade. Profit, loss. The most an investor can expect to make on this trade is the credit or premium they received. If the stock finishes below the lower strike price at expiration, the investor will achieve maximum profit. The maximum loss can be calculated by taking the difference between the two strike prices minus the premium received. This is reached when the stock price finishes over the higher strike price on the expiration date. Generally, if short calls go into the money, the trader will most likely be assigned the stock position at expiration. However, when calls go deep into the money, there is always a risk of early assignment. Break-even. The break-even for a bear call spread is the lower strike price plus the cost of the trade. Break-even equals short call strike plus premium received. Example: a 55-60 call spread valued at $2 would consist of selling a 55 strike price call and buying a 60 strike price call. Here the $2 premium would represent the max win if the stock stayed below the 55 strike price, having a $5 wide strike width, representing the max loss if the trade finishes above both strike prices, minus the premium received to get into the trade, in our example $2, leaving the investor with a max loss of $3. Time decay is working for the investor if the call spread is out of the money because they want the trade to expire, allowing them to keep the full premium received. Time will be working against the investor if the vertical has both strikes in the money because they would want this trade to continue, giving them more time for the stock to drop in price. Conclusion: this is a great strategy to use if the investor feels a stock is moving sideways lower, but not sure on their timing or wants to giving themselves a cushion in case the market moves sideways or trades up slightly. Many traders flock to the bear call spread due to its high probability of success and limited risk. But if the stock does move against a trader, it can cost them far more than their initial investment. For those looking to execute a spread with a lower probability of success, but a much lower potential loss, they should consider the bear put spread or the bull call spread. 7. Bull put spread option strategy. The bull put spread is a vertical spread strategy where the investor sells a higher strike price put option, shown as point B, and buys a lower strike price put option, point A, within the same expiration month. The investor will receive a premium or credit, as the higher strike price put will have more value than the lower strike price put. The investor uses this strategy if they believe the market will stay flat or trade higher. The lower put option is used as a hedge in case the market does trade lower, so the investor can cap their max loss. Profit, loss. The most an investor can expect to make on this trade is the credit they received. If the stock finishes above the higher strike price at expiration, the investor will achieve max profit. The max loss can be calculated by taking the two strike prices minus the premium received. This is reached when the strike trades over the above strike price at expiration. Break-even. The break-even for a bull put spread is the higher strike price minus the premium received. Break-even equals short put strike, premium received. Example: a 70-75 bull put spread valued at $2 would consist of selling a 75 strike price put and buying a 70 strike price put. Here the $2 premium would represent the max win if the stock stayed above the 75 strike price, having a $5 wide strike width, representing the max loss if the trade finishes below both strike prices, minus the premium received to get into the trade, in our example $2, leaving the investor with a max loss of $3. Time decay is working for the investor if the put spread is out of the money because they want the trade to expire, allowing them to keep the full premium received. Time will be working against the investor if the vertical has both strikes in the money because they would want this trade to continue, giving them more time for the stock to rise in price. Conclusion: this is a great strategy to use if the investor feels a stock is going higher, but not sure on their timing or wants to giving themselves a cushion in case the market moves sideways or trades down slightly. 8. Bear put spread option strategy. A bear put spread is a vertical spread consisting of being long the higher strike price put and short the lower strike price put, both expiring in the same month. The strike price of the short strike, represented by point A, is lower than the strike of the long put, point B, which means this strategy will always require the investor to pay for the trade. The short put's primary purpose is to help pay for the long put's upfront costs. Profit, loss. The max profit of a bear put spread is calculated by taking the difference between the two strike prices minus the premium paid. This is reached when the strike trades below the lower strike price at expiration. Max loss is the cost of the trade. This is reached when the stock trades above the upper strike price at expiration. Break-even. The break-even for a bear put spread is the upper strike price minus the cost of the trade. Break-even equals long put strike, debit paid. Example: a 40-50 bear put spread costing $2.50 would consist of buying a 50 strike price put and selling a 40 strike price put, have a $10 wide strike width, which is the most the investor could make on the trade, minus the premium paid to get into the trade, in our example $2.50, leaving the investor with a max profit of $7.50. Time decay is working against the investor if this put spread is out of the money because they need more time for this trade to become profitable. Time would be working for the investor if the vertical has both strikes in the money because they would want this trade to end, so there's no more time for it to possibly move against them. Conclusion: the recommendation. This is not a strategy that should be executed very often unless there is evidence of an expected downward movement. Without that, it's a lower probability of success trade that relies on the stock to trade lower before the expiration date. It requires less capital to participate than simply purchasing stock, which means lower risk, but is still considered to be a lower probability of success trade. 9. Callback spread option strategy. A callback spread is a strategy that involves selling lower strike price calls, represented by point A, and then buying a larger number of higher strike price calls, represented by point B. The lower strike price is usually an at-the-money option at the time of execution. A trader who executes this position is bullish and is hoping for a larger upward movement in the stock, but has a conservative approach. If possible, the trader would want to execute a callback spread for a credit. That why they are starting out with the upper hand. And if the stock does trade down, they will still receive a small win. The longer the expiration, the better the chance the investor has to win, as the stock needs time to make that jump to that upper level. However, more time does mean a higher cost. The closer the strike prices are together, the better for the investor, but that does come at a higher price. When the strikes are further apart, it is easier to establish this trade for a credit, but reduces the probability of the stock reaching the further out strike price. Profit, loss. This trade has unlimited profit potential. Once the stock moves past the upper strike and continues to trade higher, profits continue to build. This trade would reach its maximum loss when the stock pins at the upper long strike prices at expiration. This would mean the short calls would finish in the money and have value, while the long calls would be out of the money and have no value. Break-even. The callback spread has two break-even points and can be calculated as follows. Lower break-even equals strike price of the short call. Upper break-even equals strike price of long calls plus point of maximum loss. Example: if a trader executed a back spread by selling a 50 strike price call for $3 and then buying two 55 strike price calls for $1.50, the trader would be able to put this trade on for a zero out-of-pocket cost. If the stock stays below $50 at expiration, the trader will break even, as both options would expire worthless. If the stock trades to $55, the lower strike price call would be $5 in the money, while the 55 strike price calls finished out of the money. Here the investor loses a full $5. If the stock traded to $70, the trader would lose $20 on the 50 strike price call and profit $15 on both of the 55 strike price calls, for a total profit of $10. Conclusion: this is a good strategy when there is the possibility of really good news coming out for a company that could push the stock to new levels. This might include a lawsuit being settled or a new high-valued service. 10. Long straddle option strategy. The long straddle involves buying a call and buying a put option of the same underlying asset at the same strike price and expires the same month. The strategy is used in case of highly volatile market scenarios where one expects a large movement in the price of a stock, either up or down. Such scenarios arise when a company makes a big announcement, earnings, or other market-moving events. It is a direction-neutral strategy, as the investor only cares about how far the stock will move, but not which way it travels. If the stock trades higher, the trader can profit on the call option while the put option becomes worthless. If the stock trades down, the trader can profit on the put option and let the call expire worthless. The profit potential is unlimited, while the risk is limited to the amount paid to enter this trade type. Max loss occurs when the stock pins at the strike price on expiration. Profit, loss. The maximum gain for a long straddle strategy is unlimited, as the position can continue to pick up gains the further the stock travels in either direction. Maximum loss equals net premium paid. Break-evens. A straddle has two separate break-even points. Lower break-even equals strike price of put, net premium. Upper break-even equals strike price of call plus net premium. A trader can only lose as much as the straddle cost. Max lose only happens if a stock pins at the straddle's strike price. Maximum loss equals net premium paid. Example: if a stock is trading at $100 and one is expecting the stock to either increase or decrease in the near future, an investor can simultaneously purchase $100 call and $100 put for the net cost premium of $6. If the stocks were to trade up to $125 upon expiration, then the $100 call would be worth $25 less the $6 premium, resulting in a profit of $19. Alternatively, if the stock were to drop in price to $75 upon expiration, then the $100 put option would have a value of $25, resulting in the same $19 profit after deducing the premium paid. Conclusion: the long straddle is made up of two purchased options, which means time decay works against the strategy. Because the strategy loses value every day due to time decay, the longer the straddle is on, the more it depreciates. This strategy has unlimited profit potential and tends to work best in volatile markets. The investor need not worry about the direction of the price movement and will benefit from an increase in volatility. The amount the price changes has to be significant to make profits, as the premium paid for this strategy is generally high. 11. Short straddle option strategy. A short straddle consists of selling a call and selling a put with the same underlying security, strike price, and expiration date. Pointer represents this strike price on the chart below. With a short straddle, credit is received in profits when the stock stays in a narrow range. The profit opportunity of a short straddle is limited to the total premiums received. This strategy works best when the stock has little movement until the expiration. The investor will receive his max win if the stock pins at the strike price at expiration, meaning the investor will win both the call side and the put side, keeping the full premium of both positions. However, if the stock does have a large move, this will hurt the investor. Profit, loss, maximum gain equals net premium received. The maximum loss for a short straddle strategy is unlimited, as the stock can continue to move against the trader in either direction. Break-even. The break-even on the top side of the straddle is calculated by adding the premium to our strike price and on the downside subtracting the premium from the strike price. Top side break-even. 100.00 plus 3.50 equals 103.50. Bottom side break-even. 100.00. 3.25 equals 96.75. Example: if a trader executes a short straddle at the following prices: sell 1xyz 100 call at 3.10, sell 1xyz 100 put at 3.30, net credit equals 6.40. If the stock pins at $100, then the trader would keep the full $6.40 and achieve their maximum gain. If the stock trades up to $110, then the trader would lose $10 on the 100 strike price call. But because they received $6.40 on the straddle, they would have a net loss of $3.60. Conclusion: this is a market-neutral strategy, which makes the most sense when there is no major announcement or earnings scheduled. The traders to execute a short straddle wants the stock to stay relatively stable with little price movement during its duration. Traders like to sell straddles so that they receive two premiums, requiring the stock to have to move twice as far in either direction before they would start to lose. In most cases, the straddle price is how far the market expects the stock to move from the current price by expiration. This means traders need to be smart and have good timing when executing this type of trade. Time decay is working for the investor, as they're looking for both options to expire worthless. As time goes on, this position decays away, and the position rapidly profits as long as the stock does not have any sharp moves. Because this trade does have unlimited risk, it's recommended to be very selective when executing a trade like this and to keep quantity sizing small. 12. Long strangle option strategy. A long strangle is a neutral options strategy with limited risk and unlimited profit potential. It is performed by buying a lower strike price put, represented by point A, and buying a higher strike price call, represented by point B. The strategy is best used in highly volatile markets where a significant price move in the stock is expected, but unsure of the direction of the large move. Such scenarios might include company earnings or big announcement. When implementing a long strangle, the investor only cares about how far the stock will travel, and will profit with a large move in either direction. If the stock trades up, the investor can let the put option expire worthless and exercise the call. If the stock trades down, the investor will let the call expire worthless and exercise the put. The profit potential is unlimited, while the risk is limited to the net premium paid in this strategy. The maximum loss is reached when the stock price falls between point A and point B on expiration. Risk versus reward. A trader who enters the long strangle options strategy is banking on significant movement in the stock, either upwards or downwards, by the expiration date. If the stock trades up, there is no limit to how far it can go and how much profit can be made. If the stock trades down, the trader can make profits all the way down to zero. Traders have limited risk when executing a long strangle options strategy, as they are capped by the premium paid to enter the trade. However, if the stock price hasn't broken through the strike price on either the call side or the put side by the expiration date, the trader will lose his entire investment, rendering both options worthless. New traders are often attracted to the long strangle option strategy due to the possibility of massive gains accompanied by limited risk. However, the long strangle option strategy comes with a very low probability of success, as a trader must pay two premiums, both on the call side and the put side, and then expect the stock movement after the position is entered to travel far enough to account for both premiums paid. Profit, loss. The maximum profit for a long strangle strategy is unlimited, as the position can continue to pick up gains the further the stock travels in either direction. Maximum loss equals net premium paid. Break-even. A strangle has two break-even points. Lower break-even equals strike price of put, net premium. Upper break-even equals strike price of call plus net premium. Example: if the stock is trading at $50 and one is expecting the stock to either increase or decrease in the near future, an investor can simultaneously purchase $55 call and $45 put for the net cost premium of $4. If the stocks were to increase to $65 upon expiration, then the $55 call would be worth $10 less the $4 premium, resulting in a profit of $6. Otherwise, if the stock were to drop to $35 upon expiration, then the $45 put would similarly be worth $10, resulting in the same $6 after deducing the premium paid. If the stock stayed between the two strike prices, 45 and 55, then the trader would lose their $4 investment. Conclusion: the long strangle has a long call and a long put. Thus, time decay works against the buyer of this strategy. Unlike the short strangle, which benefits from time decay, the long strangle loses value day after day and will require the stock to break out in one direction to stay profitable. This option trading strategy has unlimited profit potential in a volatile market while minimizing the loss. The investor need not worry about the direction of the price movement and will benefit from an increase in volatility. The price change of the stock has to be significant to profit. Remaining topic we will see in next video. Thank you. Our mission is to provide a relaxing experience to our viewers with content that focuses on the natural beauty that our world provides, and we will try to cover cooking videos for cooking lovers and sharing many delicious recipes, and some motivational videos, motivational speech, motivational quotes. We bring out the collection of best audio and video. We make most powerful videos on daily basis. Your kind support will be a great motivation and inspiration to my creation. Please subscribe, like and comment, as I do my best to upload quality videos. Thank you.